So, we know what this line is here. That's the Fed decision on the 18th. Surprised everybody. No taper. Okay. Irrelevant largely to our discussion today, except for the fact that it's a great example of why you should always use stops. Everybody in creation, except for like 2 people, expected the Fed to start tapering. I did too. I wrote a paper or a piece 2 days before, 6 reasons why the Fed will taper. I still stand by the logic, but they didn't do it. The reason everyone expected it to is because the entire discussion about tapering was started by the Fed. May 22nd, when Bernanke passed off what appeared to be just a little comment, and of course it was very calculated, that perhaps the Fed would start easing up on the gas pedal, if you will, all the metaphors that you run across every single day for 100 times in financial journalism, would lighten up a bit on the taper. Would lighten up on the amount that they were pumping into the system, the quantitative easing every day, and begin to taper it off. They started that conversation. Nobody asked them to. Nobody expected them to. They started it. He then confirmed it again on the 19th and then retracted it pretty much on July 10th. But it remained in the price level, although not a huge amount. Take a look at the daily level here. Okay, these are the dailies in the euro. May 22nd, it's right around here. Okay? Look what the euro did, straight up. Okay? Market at that point was not paying attention to Mr. Bernanke. He said May 22nd, right here, that we may taper off on QE. The euro didn't care about it. The credit market did, but the euro did not. That's a column that I think I'm going to write this week. Anyway, guess what date that is? The 19th. That's when the Fed, at the end of that FOMC, seemed to confirm the intention to begin to taper. And where are we down here? We don't have to guess this. July 10th. When the Fed seemed to pull that back, that they were going to taper. Now, the interesting part about this move is that we went from 34 down to 28. And when the Fed seemed to pull back on the idea of tapering on the 20, now you should always keep in mind when you're doing in your background the fundamental aspects of what's going on. That's why I'm going through this right now. Then we'll approach because what that gives you the coloration, that gives you the benefit of the doubt which way that you're likely to go in a currency. And you need as much information as possible. But it's difficult to trade fundamental trends because you can't operate on decision points, inception points, except on rare occasions, based on fundamental information. So right here, there's no way that anyone here, say you were short from here, because if the Fed is going to taper, this is anticipation. But if they really do start to taper, it was my opinion that this would continue. You would not have had buy the rumor and sell the fact, but it would have continued, especially if they did more. So, if you were short here and you hadn't put a stop in, you got killed. I'll repeat this many times today. Always use stops. It's easier to start over than it is to start hoping and praying it comes back the way. It never does. And if it does, it costs you too much emotionally, and you can't trade that way. So, the 10th, it turns around, we go back up here. But the return only went back to, of course, 134. 134 remained the top, largely. These things don't count. You have to be completely accurate on this until we get right here. So with that background, right, this is going back a year. Actually more. It's a year, sorry. So from February pretty much on, 134 was the top. Now, we need that as background because it's going obviously to plug into our charts. So this is our, let's see if I can get a little bit longer time frame on this. We'll do, so we can get 6 months on the 4-hour chart. Okay, this gives us 6 months on the 4-hour chart. It's not as, we'll go back. So, looking for chart formations. Let's go back. We know what's here now. I just want to make sure. We'll go back to the 60 minute, which is where I would normally start. Because in my view, and this is my particular view, remember, charting, although it has a lot of tools in common, the interpretation has a lot of basics, but people have two things. They have their own preference as far as particular pictures, charting formations. They also have their own preference when it comes to indicators and many of the tools. My general approach to charting, aside from the psychological aspect that I've already spoken about, is to think of all of the various tools, indicators, support and resistance lines, astrology. You know, there is a school of astrological prediction in the stock market. I've never seen it applied to currencies. And every once in a while, I guess for humorous case for most of us, somebody will trot out an astrological predictor, and what they find is that, you know, it's not all that different than what more scientific types of charting are able to predict as far as the movement of various markets. But anyway, so I would start at the hourly. Now, the way I look at various tools is this. The general picture, I'm going to draw a chart line here, and the reason I'm using Bloomberg is because I'm very familiar. Now, this is an hourly. Very familiar with its charting functions. Okay, so there we have the first chart line drawn today, an uptrend going back to the first week in September. Not a lot of surprise there. But the way I would look at this and almost all other ones, these pictures, trend lines, support and resistance, channels, pennants, and the equivalents in candle charting are adhered to, or at least observed and looked at by almost everyone. So they have the widest audience. They have the widest sense of participation. So that's one group. Every other analytical tool, think of as having its own particular audience. I mean, these are the studies on Bloomberg. Okay? Start with a very basic one, the moving average. I personally don't think moving averages are all that useful, but I will tell you that many people do. Okay, so we look at a very simple 14-day moving average. Okay, right there. It doesn't tell us very much, but there are, especially on an hourly chart. So let's move back a little bit, and I have a point on this in 1 second. Oops, the wrong one right here. Okay, Mr. Bloomberg really does deserve his billions. I know I've made that observation before. Okay, this is the 100-day moving average. Okay, useful. Now, some people believe in crosses of the 200, the 100, all sorts of things. But if you think about who's participating in each trade, after you get through the basic pictures, such as trend lines, I'm going to do resistance and other things, you have different groups. So somebody will like trend lines and they'll like 100-day moving average. Somebody will like trend lines and RSI. Somebody will like any one of another zillion indicators. Each indicator that points in a similar way, suggesting a certain trade, becomes yet another group that is going to participate in that trade.